Did you know that in 2023, the average savings account interest rate in the United States is just about 0.05%? Now, here's the kicker. The current inflation rate is hovering around 3.7%. So, if you're keeping all your savings in a traditional savings account, you're essentially losing money every day. Let's dive into why this is happening and how you can fix it. Imagine you've got $10,000 stashed away in a savings account. With an interest rate of 0.05%, you'd earn a mere $5 over a year. Meanwhile, with an inflation rate of 3.7%, that same $10,000 loses its purchasing power, effectively dropping in value by $370 over the same period. This discrepancy is what financial experts call the real return, which is the nominal interest rate minus inflation. In this scenario, your real return is a negative 3.65%. In plain English, your money is shrinking in terms of what it can actually buy. Now, you might be wondering why banks offer such low interest rates on savings accounts. It boils down to monetary policy and the Federal Reserve. In recent years, the Fed has maintained relatively low interest rates to encourage borrowing and spending to stimulate economic growth. While this is great for borrowers, it's not so hot for savers. Banks don't need to offer competitive rates on savings accounts when they can access cheap capital elsewhere, thanks to these low federal rates. So, what can you do to stop your savings from sinking? First, it's crucial to reassess the purpose of your savings. If this money is meant for an emergency fund, you'll want it to remain liquid, meaning you can access it quickly without penalties. However, you don't have to settle for a paltry 0.05% interest rate. Look into high-yield savings accounts or money market accounts. Some online banks and credit unions offer savings accounts with interest rates as high as 4% or more. For instance, as of late 2023, some online banks are offering rates near 4.25%. That's a game changer compared to the traditional brick-and-mortar banks. Another option to consider is investing in Treasury Inflation-Protected Securities, or TIPS. These government bonds are designed to protect against inflation. The principal value of TIPS increases with inflation and decreases with deflation, as measured by the Consumer Price Index. This means your investment's value rises with inflation, helping to preserve your purchasing power. While TIPS don't offer the liquidity of a savings account, they're a solid option for long-term savings. You might also look into certificates of deposit, CDs, which typically offer higher interest rates than savings accounts in exchange for locking in your money for a set period. Right now, you can find CDs with interest rates as high as 5% for terms ranging from 1 to 5 years. Keep in mind, though, that withdrawing your money before the term ends usually results in penalties. So it's essential to consider your liquidity needs before diving into CDs. For those comfortable with more risk, investing in the stock market has historically provided returns that outpace inflation. Over the last 30 years, the S&P 500 has averaged annual returns of about 10%. However, this route requires a higher tolerance for risk and a longer investment horizon. Stocks can be volatile in the short term, but they've proven to be a robust vehicle for wealth accumulation over time. If you're not sure where to start with investing, consider using a robo-advisor. These automated investment platforms use algorithms to build and manage a diversified portfolio for you based on your risk tolerance and financial goals. They're a great way to dip your toes into the investment world without needing to become a financial expert overnight. Another tool to consider is a financial advisor who can help tailor a savings and investment strategy based on your personal circumstances and goals. They can provide guidance on asset allocation, tax strategies, and even behavioral finance to help you stay on track amidst market fluctuations. It's crucial to act now rather than later. The longer your money languishes in a low-interest savings account, the more purchasing power you lose. Start by analyzing your current financial situation, set clear goals, and explore these alternatives. Whether it's moving your money into a high-yield savings account, exploring investment options, or consulting with a financial advisor, taking charge of your money today can prevent future regrets. Remember, ignoring inflation is like ignoring a slow leak in a tire. It might not seem urgent at first, but over time it can lead to a flat, or, in the case of your finances, a flatter wallet. By making smart financial moves now, you can ensure your savings grow rather than shrink. If you found this insight helpful, make sure to hit that subscribe button for more tips on managing your money smarter. And drop a comment below. What are you doing with your savings right now? Let's get the conversation started.